Let's talk markets right now. Joining us, Stephanie Link, Chief Investment Strategist at Hightower and a CNBC contributor. Good morning, investor. Good to see you, Stephanie. I wanted to start off with your reaction to Powell. What was interesting was that it wasn't Powell that actually turned the S&P 500 yesterday. It was that bond auction, which really sort of underscores this notion that stocks are being held hostage to the bond market and what the bond market may represent in terms of financial conditions being tight or easy. How do you view the rest of the stretch of the year? A lot of people say seasonality is going to kick in. We're destined for a rally, and yet here we are. It seems like Powell wants to manage expectations around that, wants to manage financial conditions and how loose they get.
Well, in all fairness, I mean, we did rally 6% off of the recent lows. And so maybe we have a period of kind of digestion for the next couple of days. But I do think we can rally into the end of the year. And I don't know what that catalyst is going to be. Is it the CPI number next week? Is it better than expected sales from retailers next week? It's possible. But it is seasonally strong period right now, as you mentioned. And I think the economy continues to kind of hum along, Melissa. We're running at around 2.5% GDP. That's pretty remarkable considering that we just put up a 4.9% third quarter print. And it all has to do with jobs. We look at initial claims on a weekly basis, but I smooth it out over a 4-week period, and it's running at 210,000. Really still very strong. Wages still are okay, and that's helping the consumer. And then on the manufacturing side, I think we talk about this all the time, onshoring and aviation are just on fire. So you want to have exposure there. So I think those pockets in the economy are where you want to be. And at the same time, inflation is making progress. I mean, I know it's not where Powell wants it to be or the Fed, but we are making progress with regards to CPI, PCE, unit labor costs, and even productivity. And so we're headed in the right direction. And I think that's why the Fed can be less hawkish. Maybe they're still a little bit hawkish, but less hawkish. And I think that's why we can rally into the end of the year, especially since earnings revisions are getting revised higher.
Right. That 6% rally on the S&P 500, though, Steph, was made on the back of a 50-point decline in the 10-year yield. So, I mean, it does seem like stocks are taking their cues primarily from what's going on in the bond market. I want to get to your picks because they are in aviation, they are in onshoring here, and you also have Target. And with respect to the consumer, because you mentioned CPI next week, is Target a turnaround story play, or is it? I mean, relative to Walmart, its valuation is much better. There's a turnaround component to Target, but the consumer may not be extremely robust these days.
No, you're right. And by the way, just on your rates point, you're absolutely spot on in terms of the yields coming down, market going higher. I think, by the way, that rates have peaked. So that's the whole premise of why I think we are actually I think we can edge higher into the end of the year. So on Target, if I'm not buying this now, Melissa, I'm never buying it, right? I mean, and you can have me on next Wednesday and I can probably say, well, it's down 10%, it's cheaper and I should be buying more. And I will, because I do think the enterprise value being less than pre-pandemic is really very extreme. This stock was a $266 stock in November of 21. It's fallen 60%. I still think they're seeing customer traffic. Maybe it's less, okay, but maybe the whole spectrum, the whole industry is seeing a little bit less traffic because people are going more out on services, right? And they're doing more of that. So I think the digital strategy is working. I think the merchandise partnerships are working. I think some of the bankruptcies in the industry will help them. So I'm not looking for a great quarter in terms of comps. It's going to be down 5 or 6%. Maybe it's even more. But what I do think is you're going to see the third quarter in a row of better operating margins, so better profitability as they continue to cut inventories, lower freight costs, and lower overhead input costs. So all of that should help margins. And if they can be profitable in a down mid-single digit comp, that's pretty impressive. So I'm involved in it. I have been. It's not been a great stock, but I do think we are approaching the bottom.
Do you also own Walmart? I'm just curious.
I don't, because of the valuation disparity between Target. So, but obviously they've benefited, by the way, because they have much more consumables mix versus merchandise. It's opposite for Target, as you know.
Right. Let's move on to Power, or PWR, which is Quanta, and that's the grid. You're investing in improving the grid.
Yeah, at least I'm consistent, right, in terms of where I want to be in my ideas and themes. Yeah, so this stock, the reason I like it, it's actually down 20% from its highs, and I think it's concerns over the utility companies and CapEx. Are they going to cut the CapEx in a higher interest rate environment? And they're not. And I listened to all of their customers, the utilities, talk in terms of CapEx, and they reiterated CapEx, and they actually, some of them even increased it. And they have to, right? I mean, this is all about, you're right, it's onshoring. 28% is renewables, 48% is transmission and distribution, and it is about the grid and modernizing the grid. It's also about EV penetration as well. And this is all being helped by the IRA Act, whereas $370 billion will be spent on this stuff over the next 10 years. And so I think with the pullback in the shares, I like it very much long term. I don't own it yet, though.
Yeah. Oh, you don't own it yet, you said.
Not yet.
Okay, not yet. And TransDigm recently hit a record high on the back of earnings and also news of a special dividend.
Yeah, and so this is aerospace, a supplier, and their focus is on the 3 Ps: price, productivity, and profitability. So for 30 years, they've increased their EBITDA from 10 million to 3.5 billion. And I think if you have organic growth and pricing of 5%, margins are expanding. You could see EBITDA continue to grow 15% for the foreseeable future. So yeah, it's not cheap and it is at an all-time high, but I do like the theme very much.